Hey team, welcome to this week's Money News in Human Words, where I'm unpacking the key stories that impact your money and what you should be thinking about to make smart decisions in light of what's going on. So the first thing that I wanted to talk about, and you probably would have noticed this unless you've been hiding under a rock, is that the share market is in a bit of free fall at the moment. Over the last week, off the back of the US record inflation data that was released, the markets went into a huge spin, and the markets were down about 10% over the course of last week in Australia, a little bit more in the American market, and massive swings and roundabouts. We're seeing market movements of like plus or minus 4% in a day, which is really huge, huge territory, and a lot of people fearful as a result. A lot of news out there as well from the trusted media outlets, and it's got people in a bit of a spin because, understandably, off the back of what we've already seen markets declining by in the year to date, we're now seeing these further declines, and people are stressing out. Investment balances are down, share markets down. For a lot of people that work in the technology space, in addition to their actual investments, they've seen the value of their employer share plans deteriorate significantly. And, it's only natural when that's happening that people are worried about, where to from here. But one thing that I would just say, because we see a lot of people that are sort of freaking out and looking at making reactive investment decisions based on what's going on in the markets, generally not a good way to tackle things. When the uncertainty levels are high and when the fear levels are high in the market, that means that the opportunity is also high. And so instead of following that herd mentality and, rushing all in to do something in a reactive way, you want to be taking advantage of the opportunity, making sure that you're planning smart so that you're not doing anything silly that's going to cost you in the long run. But taking advantage. And I get that. Taking action is really scary when the conditions are what they are today, and you don't want to be that person that makes a mistake that costs you a bunch of money. But downturns do make millionaires, and I think if you're one of these people that says, I'm just going to sit on the fence and wait and see what happens, it's likely that you'll miss the opportunity to get ahead. So what you can do, if you think that you're in a position where you could be taking some action, is firstly, I think it's really important that for anyone that's investing at the moment, that they're choosing solid investments that are going to recover well from the current period of market turmoil that we're seeing. So good, solid, stable, big companies that are positioned well to ride out these downturns. The second thing that you need to do is be planning really smart. So it's not just about, is an investment a good investment in absolute terms? What you want to be looking at is it a good investment for you? And that means, where does it fit in your bigger picture? Does it fit in with the other property decisions that you're making, with the lifestyle decisions that you're making, with what's around the corner for you? Because if you're choosing good investments and they do fit, then you're going to be positioned well to actually take advantage and get good results when you invest. The other thing, and it's sort of implied in the other two, but just making sure that you're investing in a way where you're never, ever going to be forced to sell an investment at a time that doesn't make sense. Because if you've got good investments and you're never forced to sell, then you can let your good investments do what good investments do over a long period of time, which is make you a bunch of money. Really, really big opportunity, I think, for people out there at the moment. Obviously, a lot of noise, but worth, being smart, seeing through that noise and making sure that you're making smart moves for you. The next thing I wanted to cover is the Bitcoin and cryptocurrency saga. The market is now down 40% almost for this month, and there's a lot of people that are questioning whether it will come back. Now, I think that I talked to a lot of people that are in on crypto. I like crypto. The quality crypto investments, I do think, have a solid future. But the people that were all in on crypto and have been all in on crypto over the last little while, they're now really paying the price and hurting as a result of what we've been seeing in markets. So some of the things that we do know for sure about crypto, and we've known this for a long time. One, crypto is volatile. It has wild swings and roundabouts, and the volatility or the ups and downs of the crypto market is significantly higher than the ups and downs that we see on other traditional investment classes like Australian shares and international shares and property. We also see it also only has the value that people place on it. It's like gold or silver or any other type of commodity where it's only worth as much as someone else will pay for it. It's not like something like a share where a company has an intrinsic value because it's generating profits and it's generating returns for investors. So look, in the last cryptocurrency, in the big market run that we saw through 2020, the share market was going wild. Share markets were way up around the world. Households were cashed up because everyone was locked in their COVID bunkers and had more money to work with. And people were essentially rich. And tech workers in particular had seen huge run-ups in the value of their wealth values over that period of time because technology had just gone through the roof. So technology people, I've found, are more interested in cryptocurrency because they work in that space. So they see the opportunity that's there. Now, when you've got rich people that are cashed up and the market is moving upwards, then you see a bit of herd mentality and people piling into the market. So ultimately, at that time, people had a lot more money to speculate with. But today, with where the markets are at, with where the world is at, we've got rising inflation, rising interest rates, the share market's down, technology's way down, property market's down. So people are feeling poor, and it makes sense that people would sell. It makes sense that people are, listening to some of this noise, obviously fearful, and that's what's impacting the price of these crypto assets much more. Now, what I'm talking about really is the bigger cryptocurrencies, Bitcoin, Ether. In my view, that those technologies are proven and they're highly likely to recover from this period of turbulence. But some of the smaller altcoins and the more speculative assets, I'm not sure that they will. In fact, I'm almost certain that a lot of them won't, or a number of them won't at least. And where we've seen people, and I've talked to a lot of people with staking crypto investments where they're getting 10, 15, 20% returns. Obviously, we saw Terra Luna blow up not too long ago. That comes with risk, and it's really silly to be investing in these investments and not be aware of the risk that you're facing. If you're expecting a 15% return, the risk is about double that it is on the share market. So it's likened to investing in a really specky small company, and some of them are even higher than that. So I think if you're buying crypto, you want to make sure that it's a solid part of a plan. Now, my take is that there's opportunity out there now. I thought it was good buying last week. I think it's good buying this week, but only where it fits in as part of your broader plan. And like, I got some crypto in Bitcoin. It's the only one I bought. The only other one that I personally would buy is Ether. And I think that, I've only ever bought, I've never sold these investments, and they're still up from where they were. While the short term is down, I was looking at the 5-year return on Bitcoin, and it's like still 700%, which is significantly higher, obviously, than the share market. Now, obviously, it is speculative and suffers through periods like the one that we're seeing now. But I think that it does have a long-term future. If you're going into this market, though, you want to make sure that it's fitting in as part of your plan so that you don't get burnt. Another really interesting thing that came out just overnight, actually, in the news was around the New South Wales government announcing this shared equity scheme where they're going to be co-investing with first home buyers of up to 40% of the value of a property. That's going to help nurses, teachers, and police officers get into the property market. Now, that basically works on purchases up to $950,000. They will co-invest with you for up to 40% on new properties and 30% on existing properties. It's a trial for the next 2 years to see how it goes. And there's only 3,000 places that are available in this scheme. So it's not huge, but it's an interesting testing of the waters to see what happens as a result. And look, whenever I put content out around these sorts of things, I get a lot of comments from people saying about how the government are just doing this because they want to own everything and they're doing it to make money. And look, I suppose they wouldn't be doing it too much if they were going to lose a heap of money. But reality is that it's helping people get into their first homes that might not otherwise would. This is an option that you can choose to take or not take. So I think overall, it's definitely good that they're giving you the option. Whether the option is a good one for you is another thing. But for people that are struggling to afford the value of a property all on their own, I think it's a great thing to help them get into the property market. And this scheme comes at a cost of $740 million to the government. So it's not an immediate money spinner, although as property values go up over time, no doubt they're going to benefit from some of that upside. But if you're the person that you can't afford 100% of your home, and having the government own 40% of it or 30% of it or whatever the number is going to help you get into the property market sooner, I think it's a really, really good thing. So I think more will come on this. The budget's actually coming out on the 21st of June, so we'll know more when that happens. And yeah, I think it's a great scheme for people to take advantage of in the right circumstance. Keeping with the property theme, I was looking at some really interesting data last week around the regional house price growth outstripping the capital cities of Sydney and Melbourne. And basically, some of the interesting highlights from these stats: over the last 12 months, median house price in Sydney has increased 16.4% to 1.25 million. In Melbourne, it rose 9.4% to 930,000. Now, in the same period of time, the median house price in regional New South Wales jumped 29% to $800,000, and in regional Victoria, it rose 17% to $640,000. Tassie holds the record for the biggest jump in regional house prices, with values increasing over 30% over the year to $520,000. And so we've seen this huge run up in regional property values over that period of time. What you also see from that data is that the gap between the capital city prices and the regional prices are getting much smaller. So in New South Wales, the gap is only 400,000, which is obviously, it's a big number, but 800,000 or 1.25, we're talking about a much smaller gap than what we'd seen in the past. Now, throughout the course of this year, we've seen the median house price in both capital cities falling. So in the latest data that's came out from CoreLogic, the combined value of residential homes fell to 9.97 trillion at the end of May. And dwellings were taking longer to sell, essentially. Since peaking in 2021, though, $95,000 declines we're seeing in Sydney and $105,000 in Melbourne. But in the regions, interestingly, the regions have only fallen by $10,000 in New South Wales and $5,000 in Victoria. So we're seeing the prices come off way more in the capital cities than what they have in the regions. Now, how that continues, I think, is a really interesting thing, and people are going sort of where to from here. Basically, what's happened is that the COVID pandemic led to a lot of restructuring of how people are living and working. This massive increase in the ability of people to work from home has meant that people are really questioning whether they want to be paying, $2 million to get a 3-bedroom house with maybe a cupboard in the wall in Sydney versus getting a 5-bedroom mansion somewhere in the regions. And look, obviously I couldn't predict the COVID pandemic, but when I did write my book a few years back, I talked about the fact that in the future, people are going to be able to live and work from anywhere. And I wondered why people would pay so much for properties in around capital cities, and predicted that people would sort of move out into those regions more. And that's absolutely what we're seeing now. Now, that being said, what I think, and while I don't have a crystal ball, but I really do believe that there's probably going to be a number of people that have moved to the regions that will get sick of that. There'll probably be a lot of people that move there and love the regions and stay there forever. There'll probably be a lot of people that move to the regions because they wanted to save a few bucks, realize that they don't have the same amenities and access that they did have when they were living in the capital cities, and then they'll move back. Now, will that mean that there's a free fall in property price in regional Australia? I think probably not, but I think it will impact the future growth prospects of those regions. And in particular, when you consider the fact that the regions have run so hot over the last little bit. So there's lots of different ways to be right, I think, when it comes to property. And I think doing something that's good and getting results, people are still going to make money on property over time. But it will be really interesting to see what happens in the property market and in the regional property market in particular, as these interest rate rises kick in and the filtering through of property price declines actually continues throughout the course of 2022. Changing tack slightly, one of the things that's got my attention last week is some of the horror stories that I'm seeing from tech workers around their RSUs and restricted stock units tanking while the tax bills are actually increasing. And I think a lot of tech workers have seen the value of their employers' shares being seriously decimated over the course of this year. Essentially, for anyone that's not across all of the details here, RSUs or restricted stock units is when the company that you work for essentially gives you a bunch of shares that then vest or become available to you over a period of time. Now, when those shares become available to you, it's typically like once a year over a 3-year period, you receive the shares. And at that time, a tax liability is created with the ATO. So you can choose to sell the shares or you can choose to not sell the shares. But whether you choose to sell the shares or not, the tax liability is still the same. So I'm talking to a lot of people, and some in really tricky positions where they've been given all these shares that have become available to them when the share price is much higher. The tax liability has become like accrued essentially to them at that price point, and then the value of those shares has declined. And as a result, some of them have tax bills that are now worth more than the actual shares are worth, and they're trying to struggle to figure out, like, how do they actually find the money to pay the tax bills? And in the meantime, they've just seen the value of all of their wealth basically disappear overnight, or sometimes even go negative. So look, I think it's generally not a good idea to have all of your wealth concentrated in one company. But when you work inside a company, the what's called involvement bias kicks in, and you think that the company's got good prospects. Of course, it's going to succeed. It's got the good snacks in the snack room and the nice t-shirts and stuff. And it's hard to escape that psychology that makes us think that things are going to recover and potentially recover faster than it's going to be. But if you don't have a good plan in place around this stuff, where your tax is covered, where you've got a diversification of your wealth, you're in for a pretty stressful year ahead in my take. So there's a lot of considerations, and it is quite complex with this stuff, but it highlights to me that some of these horror stories that we're seeing over the last little bit, that you really need to have a solid plan if you want to be smart at the time and not be facing that amount of stress. So I think can be complex. Get some good help, get some good advice if you need to get the results that you want and not end up in trouble. And look, my last piece for this week is around, I've been getting a lot of questions on how capital gains tax works if you rent out a room in your home. Now, essentially, for anyone that doesn't know, if you own your own home, it's pretty common that people might rent out a room in that property. Now, as per the tax laws, when you rent out a room in your property, you're required to declare that rental income as essentially investment income. And what that does is it essentially makes the room in your home an investment. Now, that can create some deductions around your debt, and essentially running a piece like an investment property, similar to what it would be if you were using one room in your home as a home office. But what it also does at the same time is it creates a capital gains tax liability on your property when you sell for the portion of your home that you're running as an investment versus the portion that you're running as your own home. So this can get really, really complicated when it comes to tax returns. And I think that the considerations around this highlight the importance of understanding the implications before you jump in and make your move, so that you don't end up with massive headaches for very little benefit, or sometimes even no benefit as well. So know the rules, how to use them to your advantage and your best place. Guys, I hope you found that helpful. And if you've got anyone else that you think would benefit from hearing this content, would love for you to give it a share around. I will catch you on